Thanks, Stephanie. Hope everybody is doing well. Notice I didn't ask how you're doing because I always laugh when I get on the Zoom meetings. People go, "How are you doing?" Like, and everybody's trying to unmute, go, "Fine, fine, fine." Anyway, I hope everybody is doing well. Hope you enjoyed the Thanksgiving holiday as we're rapidly coming into the Christmas holiday. So, all right. So what I wanted to do today is I'm going to go over the 1031 process. Please feel free to, ask questions. I'm not, Stephanie, how are we going to deal with questions? Did you want them typing it in the chat box and then you'll read it later? How did you want to handle that?
Honestly, whatever is your preference. We have some speakers who like to handle questions every 10 to 15 minutes, or we can have everyone type it in and you can answer them collectively at the end, whatever is easiest for you.
Why don't we do it collectively at the end?
Okay, sounds good.
And then that way, because if I'll try to leave enough time for the questions. So just make sure that if you hear something and you want to type it in, we'll address it at the end. I think it'll be a better flow for that. Okay, thank you. All right, so what I'm going to go over is we're going to talk about, the taxation, so both state and federal. We're going to talk about pros and cons of doing an exchange. I'm going to take you through the process of the exchange. So some of you are probably experienced with working with exchange clients. Some of you may not be. So just for those that are experienced, just remind you of how everything flows. I'm going to insert some information through the deal flow itself. I'm going to take you through the exchange equation, delayed exchange, the ID rules. We're going to go over current situations and challenges that I'm seeing in our industry. Okay. And then at the end, we'll do the question and answers. All right. So the first thing about 1031s is, why do people do them? Well, when you're talking about 1031s, that is actually a part of the tax code. So when an investor has an investment piece of property and they sell it, then they are potentially subject to taxes when at that point. So there are 4 different taxes that an investor may be faced with. Now, when you have investment real estate, you depreciate that property while you're operating it. So when you go to sell the property, there's going to be a tax associated with the depreciation. It's called the recapture tax. Now that tax rate is at 25%. Then the other tax that an investor is going to be faced with is the capital gain tax rate. So if they've owned the property for more than a year, they're going to be subject to capital gain rates. Now, currently there are 2 different rates. There's 15% and then there's 20%. The 20% rate will kick in if you're a single taxpayer and your income is more than $441,551 and above. If you're a married couple filing a joint return and your income is more than $496,601 and above, then you're going to be at the 20% tax bracket. Anything below that is going to be taxed at 15%. Now, sometimes investors may think, well, my income is well below those numbers. But if you sell a highly appreciated asset, it can easily throw you into the higher tax bracket. Okay, so just keep that in mind. It's not what you have this moment, it's how what you're selling is going to impact your current tax rate and to see where you're going to actually end up. And then there's the third federal tax, which is the net investment income tax. That's what's better known as the Obamacare tax. If a taxpayer earns more than $200,000 and they're single, and a married couple more than $250,000, they're going to be subject to an additional 3.8%. So as you can see at the federal level, you're looking at 25% for recapture, capital gain rates of 15 to 20%, and then the net investment income tax at 3.8. Now there's the state of California. Now, California does not have any capital gain rate itself. It's just ordinary income. And California's tax rates are progressive. So the rates range from 9.3 to as high as 13.3. So as you can see, when an investor sells a piece of property, they can be looking at potentially paying anywhere from 30, say to 35% in taxes on the gain of the sale of that property. So if you think about it, if somebody has gain on the sale of a property of around $700,000, they're potentially going to pay somewhere between $240,000 to $250,000 in taxes on that $700,000 gain. So fortunately, they have the opportunity to defer those taxes through a 1031. Now, let's talk a little bit about the pros and cons of an exchange. Well, the big advantages of doing an exchange is I can defer. Now, you're not hearing me say the word free because there's nothing free about a 1031. It's a deferral program. So as a taxpayer, I can defer the recapture tax. I can defer the federal long-term capital gain rates tax. I can defer the net investment income tax. And the state of California also complies with the 1031 code. So I'm able to defer California taxes as well. When I do that, that helps me build my wealth. So in other words, instead of me having to give the government, say, $250,000, I'm preserving that equity, and now I can go out and buy more. Okay, so think of it sort of like an interest-free loan, if you will, from the IRS in the state of California. So I'm using that money to go buy more property. I also can use a 1031 by accumulating wealth by leveraging. Now, what do I mean by that? Sometimes you might have a client that's selling a piece of property and maybe they don't have any debt on the property when they sell, so there's no loans. So if they wanted to really take advantage of the 1031 code, they might go out and put some leverage on the new property while they're spending all their cash. So basically, potentially doubling their investment portfolio by utilizing leverage. Okay. Now, I never recommend anybody putting a lot of leverage on anything, as I'm sure you guys don't as well, because first of all, it has to cash flow, it has to make sense. But you can utilize leverage to buy more property. It's also available for diversification. And we're seeing a lot of that right now where folks are selling properties that they're diversifying by asset class along with geographically. A lot of people are exchanging out of California. When I say a lot, I'm not saying 100% of our transactions are California outside of California, but I will say that there's a good portion of them that people are exchanging out of California to go into higher cash flow properties, okay? Because properties typically have a little difficulty cash flowing here. So they'll diversify into other states, okay? They're also diversifying by asset class. So some people maybe if they have a shopping center, given the current situation that we're dealing with, if they sell that shopping center, they probably want to get out of that and go into maybe an apartment complex, or maybe go into single family rentals, or go into a Delaware statutory trust or something along those lines, industrial as well. So you can diversify. The key to remember is it basically, when it comes to the 1031, is it has to be real property that you're buying and that you're holding for investment. Another advantage to 1031s, and I'm going to say this under current tax law, is that if you're an investor, and as a part of your estate, you plan on passing any properties that you have to your heirs, an investor might exchange when they ultimately, to build that portfolio, when they pass away, under current tax law, those properties get a full step up in basis. So that means when the heirs inherit the property, they're going to inherit the property for the market value of the property at the time of passing. So you're probably gonna have to get an appraisal to determine what that is. And then what's interesting though, is if those heirs turned around and wanted to sell the property, shortly after receiving it, well, their sale price is probably going to be very similar to what it was for the market value. So there's no gain to them. And all the taxes that the investor has been deferring is not passed on to the heirs. It's not passed on to the heirs. Now, again, I prefaced what I've just said by under current tax law. Anything can change. Now, with pros, there's going to be cons. So there are going to be specific rules that the taxpayer has to comply with. We're going to go through all of that. So what are the rules? What are the time restrictions? One of the downsides to a 1031, and not everybody grasps this, at least right away, is the fact that you do not get a brand new basis in the property. So your old basis moves with you. Now, for those of you that may not be familiar with the term basis, that means what you originally paid for the property minus the depreciation plus any capital improvements. That will be your adjusted basis. So that's the where you're going to determine what your gain is on the sale of the property. So when you do an exchange, the basis you sold from moves with you to the new property. So you don't get a brand new basis in the property. So for example, if somebody has owned say for example, a single family rental for maybe 20 years, under the current depreciation schedule, they only have about another 7.5 years left on that property. So when they go out and buy a new property equal to exactly what they sold for, they only have another 7.5 years left on the depreciation. So if they held that property for 9 years, by year 8, they're out of depreciation. And remember, depreciation lowers your real estate taxable income while you're operating the property. So the downside to an exchange is that you do not get a brand new basis in the property. I'm going to show you an example of how you can increase the basis a little bit later. Lack of liquidity. What do I mean by that? Any cash you keep, you will pay tax on. Okay. So you have to buy real property as a part of the exchange. You cannot recognize losses. Now, it's important that when you're working with clients that are considering doing an exchange, it's very important that they consult their tax advisor to determine whether they need to or should do an exchange. Because as real estate professionals, and as a 1031 company, I'm not going to know if they have any suspended losses, because if you have suspended losses, you can utilize that against some of the gain on the sale of the property. And that would be a good time to recognize those losses against any gain. Because the reality is, if you don't need to do an exchange, don't do an exchange. Only do an exchange when it's going to benefit you. Possible risk of higher taxes in the future. I'll talk a little bit about that at the end. And then as I mentioned earlier, it's tax deferred. It is not tax free. Okay, so just keep that in mind. All right, so let's go through the basic guidelines for an exchange. There are 4 basic guidelines that an investor needs to meet to qualify under the tax code. The first guideline is going to be the property qualification. So, was it real property that was held for trade or business or for investment? The second requirement is going to be, in order to defer the tax, you need to purchase property equal to or greater than your net sale price and spend all of the cash and replace any existing debt. The third requirement is going to be, you have a certain amount of time in which you need to complete the exchange. So you have 45 calendar days from the date of closing to identify. You have 180 calendar days from the date of closing to complete your exchange, or your tax filing date, whichever is earlier. And I'll go over that a little bit later, because we're going to break down each one of these guidelines. And then the fourth guideline is, you have to identify the property. So there's specific identification rules. And I will tell you, the hardest thing in an exchange is going to be the first 45 days. Okay. So I always like to, when I'm talking to clients, I explain to them, please keep your eye on the prize, because the first 45 days is going to be the hardest part that you're going to have to deal with in the exchange, because that's when you have to identify what you want to purchase. Okay. So now let's talk about the property qualifications. When we talk about property qualifications, the first guideline, the property that you're selling has to have been property that has been held for investment or for trade or business. Now, most of the time you might be working with people that are just basically holding property for investment. They're not necessarily operating their business out of the property, but the code works for both uses. So an investment property or property where somebody may be operating their trade or business. For example, trade or business could be if they're operating a dental office and they own the building, or a restaurant and they own the building, and they can exchange that. Okay, so that qualifies just as well as somebody that owns rental property. Now, when we talk about that, the property must be held for investment. The question that comes up often in my world, and probably yours as well, is, well, how long do I have to hold the property for it to be declared held for investment? Well, there's nothing mandated in the code specifically that says you have to hold it for 1 year, you have to hold it for 2 years, or you have to hold it for 3 years. Okay, it goes down to what was the taxpayer's intent. So now holding the property for longer periods helps to substantiate the intent, but that doesn't mean it's you're completely protected. So The first view might be hold it for 24 months, so basically 2 years. There's a couple of the private letter ruling, and then there's a revenue procedure that addresses that if an investor has held the property for 24 months, then that qualifies for the safe harbor, for the 1031, for the held for investment intent. So some more conservative tax advisors might say, no, I want my client holding the property for at least 2 years. Now, more aggressive tax advisor goes, well, no, maybe 12 months is sufficient because it's going to cover 2 tax returns. When you hold an asset for more than 12 months, typically, unless you're a dealer, you're going to fall under the long-term capital gain rates. So as you can see, there's 2 different views of it. Now, does this mean that somebody that holds it for under 12 months can't do an exchange? Not necessarily. However, I would caution anybody that's holding a property for that hasn't owned a property, say, for at least a year, to make sure that their tax advisor is comfortable with the fact that they've had it for a short-term hold. Because like I like to say, you're never going to see me with you at the audit. So you need to make sure that whoever's a tax advisor is guiding them through this process. So once you're dealing with a client and they're going to be selling an investment property, I think it's very important to get the tax advisor involved immediately so they can go over everything with the client. And hopefully their tax advisor understands 1031s. So held for investment is the biggest question that comes up. How long do I have to hold? Well, nothing is specifically mandated. Unless you're dealing with related parties and swapping with related parties. And now you have a 2-year maximum that you have to hold it. But other than that, there's nothing mandated. Longer is always going to be better to help establish the investment intent. Okay. Now, the other property qualifications is what is considered a like-kind property. Okay. I'm sure a majority of you already know that when we talk about like-kind property, we're not talking about apartment building for apartment building. We're not talking retail for retail, office for office, raw land for raw land. As you can see by this colorful slide here, it's basically investment real estate for investment real estate. And that's where we talk about asset classes, where people are moving from different asset classes. Well, I've got people that are selling raw land, buying income producing. Then I have people that are, as a part of their exchange, buying income producing property and buying raw land too, that they may want to develop for future property later. So you can go both ways with that. So as you can see, it's very, very broad. The key to remember must be real property, no personal property. And when I use the words personal property, I'm not talking about a primary residence. I'm talking about furnishings, fixtures, equipment. Okay. So like-kind property is real estate, investment real estate for investment real estate, or real estate held for trade or business for either real estate to be held for trade or business or investment real estate. Okay. They're interchangeable. All right. So let's go to the next guideline, which is known as what we call the exchange equation. When you're doing an exchange, in order to defer the tax, you need to purchase property equal to or greater than your sale price net the closing cost. You need to spend all of the cash and replace any existing debt. So in my example here, we're showing that they're selling for 900, buying for $1.2 million. The debt that was relieved when they sold the property. Now, sometimes people think, well, was this the debt when I bought the property? No, it's actually the debt at the time of closing. So whatever the balance of the loan, that's the amount that you need to replace. So in this example here, it's $300,000. Then there's closing cost. We're going to go over that in a little bit of $60,000. And then the cash coming out is $540,000. So they spent $540,000 to put down on the new property of $1.2 million. Utilize that leverage I was talking about by getting more leverage to 660. So in this example, they spent the cash, replaced the debt. So there is no boot. Now, boot means taxable, by the way, in case you forgot what that is. Here's the thing. Every transaction may have some level of boot on it. It's just the nature of the beast. But your goal is to try not to have any boot. So in order to do that, you're spending all the cash, replacing all the debt, and your closing costs are in agreement with what's considered an exchange expense. Okay, we'll cover that in a minute. Now, if you decide to go down in value, so if there's an investor that was selling for 900,000, they want to buy something for 700,000. They got a new loan of 300. They only put $400,000 down. That means they did not spend all of the cash. So that $140,000 would be taxable to the amount of gain recognized. That's called boot. So they'll pay taxes on that portion. Now, maybe they're going to use the 140 to go out and buy another piece of property. You could do that, but you also can do a partial exchange. So when we talk about doing partial exchanges, it's not an all or nothing system. So sometimes people think, well, God, I want to keep some cash. You can keep some cash. The key is to make sure that you're not keeping too much cash, or you're not getting a high enough loan where you're not going to benefit from the exchange. So let me give you an illustration of that. In this example, we're showing that there's $140,000 of cash boot. If this taxpayer's gain on the sale of the property was $300,000, the boot is $140,000. They're still protecting tax on $160,000. So doing a partial exchange makes sense. If the taxpayer's gain was only $100,000, then doing an exchange would not make any sense at all, because they're going to pay tax on the $100,000. So that's why it's important when somebody's considering a partial exchange to make sure that they're still benefiting from the exchange. And who's going to give them the answer? Their tax advisor, okay? And also, people may do a partial exchange because they have some level of loss carryovers that they can use against some of that gain, and they can free up some cash and ultimately not have any taxes on those that boot, because they have losses to offset that. So these are some of the intricacies and why it's so important to make sure that their tax advisor is involved in their decisions. Now, here's something you need to be very careful about, and it happens on transactions. Somebody sells a property for 900,000. They buy a property for $1.1 million. So they're going, okay, I'm buying higher than what I sold for. I'm good to go. Not really, because in this example here, they didn't spend all of the cash. So in other words, they got a larger loan to make up the difference, okay, and kept 140,000. So even if you're buying higher than what you're selling for, unless you spend all of the cash, you've not met the exchange equation requirement. So be very, very careful. When you're working with investors, watch the loan amounts when they're buying the replacement property, and they need to be watching it as well to make sure that they're spending all of the cash on the property, not just looking at the one figure that they're buying higher. All right, so these are some of the things that are going to come in with the exchange equation. Now, let's talk about closing cost and what's considered an acceptable exchange expense and what is not. All right, so when you think of acceptable exchange expenses, think of something that is in relation to having to transfer the property. So the transfer of the property, like a capitalized cost. Okay, real estate commissions, totally acceptable exchange expenses. Title insurance premiums, closing fees, escrow fees, any legal fees associated with the transaction, transfer tax, notary fees, recording fees, the qualified intermediaries fees. Those are all costs of transferring the property. So those are considered acceptable exchange expenses. Now, there's expenses that may come in on a transaction which do not necessarily qualify for an exchange expense, such as prorated rents and security deposits. Now, you'll see that more on retail, multi-industrial office buildings, apartment buildings, where you've negotiated a transaction where you're saying, okay, well, we're going to credit the buyer with the prorated rents and security deposits. So say that figures around $30,000 for an apartment complex. If you're crediting the buyer with $30,000 for prorated rents and security deposits, that means that the buyer is not bringing in that $30,000. So that money is not coming into the exchange and therefore is going to be taxable, okay? Because prorated rents and security deposits are a cost of operating the property. Lender issues, okay, so lender fees such as points, prepayment penalties and such. Okay, those things are cost of financing, not a cost of transferring the property. Those are looked at very differently. We see this third one quite often, paying the buyer's closing costs. Okay, is it going to kill the deal? No, but you have to understand that if you're paying the buyer's closing cost, okay, with with the transaction, that money is not coming into the exchange. How do you overcome this? Well, you bring in the money for your points. You bring in the money for your prorated rents and security deposits. You bring in the money to pay the buyer's closing cost. And therefore, then all the cash is coming into the exchange. So that's how you can overcome some of these items that are on the in the transaction itself. Lender policy, if there's impounds and property taxes. So if you're dealing with a lender that's going to require impounds, you're going to have like maybe 3 or 4 months worth of money coming in to cover the impounds, right? Because you may have to pay for the property, the insurance, for example, property taxes, the proration of that. So there's these issues that come into this, and then therefore, if you're using proceeds from the exchange for that, then that's going to end up being boot because that's not a cost of transferring it over. What I highly recommend is that the client brings their closing statement to their tax advisor to go over everything. We as a qualified intermediary can highlight things, but we really prefer that the client work with their tax advisor to go over these issues with them. Okay. So again, certain things are acceptable, certain things are considered taxable. Okay. Now, remember I told you one of the downsides about doing an exchange was that you're not getting a brand new basis in the property when you're selling. You have your old basis is moving over with you. So here's an example of how this plays out. If you sell for $1.2 million, your adjusted basis, say, was $400,000. Your gain is $800,000. You buy a new property for the same price you sold for $1.2 million. Your gain deferred, $800,000. You're going to subtract that. And your new basis in the new property is $400,000. So as you can see, you didn't gain any higher basis in the property. So if you're in that situation where you're running out of depreciation, this transaction is not going to give you any more depreciation. Okay. Now, if you go out and you buy a property of higher value, say 2.3 million, the gain deferred, 800,000. The new basis in the property is $1.5 million. Now, of that $1.5 million, 400,000 is the old basis. And to the extent of improved property on the $1.1 million, they're going to get a new depreciation schedule. So when we talk about exchanges, more is good. This is an example in the depreciation side of it, where buying more is going to be better if you're running out of depreciation. Okay, again, a lot's going to depend on how long they've owned the other property. So when you're thinking about working with your clients that are looking to buy property, and if depreciation is something they need, make sure you're keeping an eye on where they are for how long they have left of the depreciation on the property they're selling. Okay. So just to highlight it, more is going to be good in this situation because now you're going to get, a new depreciation schedule on the new money. All right. Now, the steps you should be taking when you're taking a listing, I'd like to say, all right, when you're looking and working with investors, as I mentioned earlier, it's very important to make sure that your client is consulting their tax advisor, okay? It's something they should not be doing without consultation of the tax advisor because the tax advisor knows their situation. They can determine whether your client needs to do an exchange or not do an exchange. Sometimes as real estate professionals, you don't know what's going on, probably not sometimes, most of the time, with their total tax returns. Sometimes you don't know that when the property that you're helping them sell was a part of an exchange as well. So in some instances where they're selling a property very close to what they paid for it, you're thinking, well, they probably don't need to do an exchange. I don't see much in the way of gain here, without knowing that they did an exchange into this property. And remember, I told you the basis moves with you. So while it may not look like there's gain initially, there is gain because it was a property that was exchanged into. Again, so important to make sure that they consult with their tax advisor. And all I can say is you keep your fingers crossed that their tax advisor understands real estate and 1031s. And I say that because not every tax advisor does. Okay. The tax code is huge. So some accountants specialize in real estate and some do not. So, and those that do not, that have worked with their clients, now have to get up to speed on what a 1031 is and how to look at and analyze all of this. It's also important that your client consult a qualified intermediary. There's going to be two different discussions that's going to be had between, if you're talking to me, if I'm talking to the client, that I'm going to have with the client as opposed to what the tax person's going to have. So there's going to be two separate conversations going that eventually will merge. It's important for you guys to confirm who is the taxpayer for the property. Now, a lot of times real estate professionals are looking solely to the title report. So whether it's the prelim or property profile, or whatever the situation may be, you're looking at the title report going, oh, well, John Smith owns this property, or John and Jane Smith own this property. Well, John and Jane Smith didn't tell you that they put this into an LLC 3 years ago and chose to have this LLC tax as a partnership. So you're thinking it's just John and Jane Smith when it could be the JJS LLC tax as a partnership. Okay, very important to understand who is your taxpayer that's selling the property, and then confirm that your purchase agreement matches the tax ownership. I have to tell you, this comes up more often than you might think. I would say if I have to put a percentage to it, I'd say about 30% of the time we run into issues where the taxpayer is not the same that's on the purchase agreement because they didn't change the title when they changed the tax ownership. Okay, so just keep these things in mind as you're going through the process. All right. Now, you get the property, marketed, you open up escrow. That's when the role of the qualified intermediary preparing documents can officially begin. So keep in mind that you must have a qualified intermediary in place prior to the closing of the sale, not after the sale is closed. We have to be assigned into the contract. So our role will begin when they open escrow. Now, you want to set up the exchange. You may want to wait a little bit to get past the due diligence period, okay? But you can set up the exchange once you open up escrow, or you can wait till after the due diligence period is over, where you figure all the contingencies have been met, and then you can set up the exchange. But the exchange has to be set up before the closing takes place. Okay, last minute exchanges are doable. They're not preferable, by the way, but they are doable. All right. So what happens is when you get into escrow, the communication is going to be between the qualified intermediary and escrow. Your client's obviously involved in this. We're going to be asking, as a qualified intermediary, we're going to be asking for a copy of the fully executed purchase and sale agreement, the prelim, and the escrow instructions. Okay. Different parts of the country do different things, but basically the current deed or prelim, and the contract for certain. From there, we prepare the exchange documents. So the exchange documents are the linchpin that keeps this all together. So we're going to bring in the exchange documents. Your client has to sign those documents prior to closing. The closing statement's going to show the name of the qualified intermediary, for the benefit of whoever's selling the property, because that's going to be your seller. We look at the closing statement. We have to sign the closing statements. We typically get this about the day before their closing. We take a look at it, and then we have to sign off on it. When the buyer brings in their money, they get the deed, the money comes to the qualified intermediary, and then that starts the time frame for the exchange. So this is when the 45 and 180 day period will begin. Okay. Now, anybody closing, just to highlight an issue here about the 180 days, anybody closing transactions during this period right now, say between October 18th and December 31st of 2020, that means that they're not going to get the full 180 days, because the code says that you need to have 180 calendar days or your tax filing date, whichever is earlier. To get the full 180 days, they'd have to file an extension on their tax returns. So my conversations during this period right now is that if you're an early tax filer, you're not going to be right now, okay? Do not file your tax returns until you've completed your exchange. So if you're getting to April 15th, you're going to need to file an extension in order to get the full 180 days. The 45 days starts at the same time. So as you can see, both the 180 and the 45 begin. I'm going to circle back to this in a little bit. But now say you get under contract with the replacement property. Now, it's very important if you're using the California Association of Realtors forms that you put in there when you're working with buyers that are doing exchanges, that you put in there that the buyer is intending to do a 1031 tax deferred exchange. Because unless they've changed the forms recently, they do not allow the buyer to assign. So you can always add the last minute language on the sales side, but it's not as easy on the buy side. So very important if you're working with buyers that are doing exchanges, that when they're making the offer, they're putting in there that the buyer intends to do a 1031 tax deferred exchange. Talk to your broker whether they want you using the seller's exchange supplement on the sales side and the buyer's exchange supplement on the buy side. Every firm has their own requirements, and I don't get in the middle of any of that. Okay, so do whatever your broker tells you to do in regards to how you deal with the exchange language. You get, so once we get involved in that, then what happens there, we're going to prepare the exchange documents on the buy side. When you're ready to close, we're going to wire the funds in. The deed's going to go directly to the taxpayer doing the exchange. So that's the cycle. It looks all nice and neat right here on this little Zoom. I call them Zoominars. All right. Once you get into the trenches, it gets a little messier because you're dealing with variables everywhere you go. And we'll talk a little bit about that later. Okay, so let's talk about the identification. Remember, I mentioned that the hardest part to the exchange is the identifying. So your client has the first 45 days to figure out what property or properties they're going to want to purchase as a part of the exchange. Now, when we talk about identifying, regrettably, you can't identify the phone book. You cannot identify the phone book, okay? You have to be very careful which rule you're going to be using. So most of the time, people use what's known as the 3-property rule, which means you're physically limited to 3 addresses to what you identify. Now, if your client wants to identify 4 or more properties, the next rule they're going to default to is going to be the 200% rule. Under the 200% rule, you can identify 4 or more properties. But when you add up the fair market value of all of the properties identified, it cannot exceed 200% of your sale price. So when somebody talks to me, they're selling a property, say for $650,000. I'll say, okay, where do you plan on purchasing? They go, well, we're going to be purchasing in the same area. Well, if you're selling for $650,000 and you're going to be buying something in the same area you just sold, the likelihood of you being able to use the 200% rule is slim to none. But if you tell me that you're selling for $650,000, but you want to go off and purchase maybe a bunch of single family homes throughout the Southeast or the Midwest area where you can buy single family homes for $100,000 to $250,000, you very likely could use a 200% rule because you can identify on a $650,000 sale, you can identify, say, 4 or 5 or 6 or 7 properties as long as the value is within $1.3 million or below. But if you exceeded the $1.3 million in this example, now you're in the 95% rule, which means you have to close on 95% of the total values of all the properties you've listed. So basically you have to buy your entire list. Okay. Now, when we talk about identifying, this is the formality. There's a piece of paper that, well, at least we as a company, and I'm sure most qualified intermediaries do as well, provide the client with the identification form itself. Okay. So this is the form that they're going to fill out. Identifying doesn't necessarily mean that you have to be under contract with the property. So sometimes people get confused about that, thinking, well, do I have to be under contract? Well, technically, no. But from a practical standpoint, you should be, because you can only purchase what is on that list. Most people are not going to fill out this identification form until they get closer to the 45th day. Because when you're in a transaction and you're making offers, you're not going to be putting down every property you made an offer on. I mean, say you made an offer and the offer was accepted. Now you're going through your due diligence, you're having your inspections. Well, maybe after you have your inspections, you find out that it's a toxic waste dump and you're not going to want that property. So you don't have to put that property on the list. So now you move on to the next one. That's why most people are not going to do their ID form until they get closer to the 45th day. So hopefully by that point, they'll be in contract, in a solid contract with one or more properties that they can close on. Okay. So when we talk about examples of identifying, when your client's identifying, they're going to have to put down the address, the city, and the state. So here's an example of the 3-property rule. So my first 2 examples I have address, city, state, address, city, state. The third one, it has address and city, but they did not put the state down. There's no state. You have to put the state. We don't know whether it's Norco, California or Norco, Louisiana. Okay. And believe it or not, we get ID forms where they do it on 2 and forget on the 3rd. So my recommendation is that anybody that has an identification, that they send it in during business hours, okay, ahead of the 45th day, maybe like on the 43rd day. If there's any issues, okay, then they can get addressed. Now, we're not going to know whether you have put the addresses correctly down or not. So as real estate professionals, you might want to take a look to make sure they're writing the right address down, because actually it's your client's responsibility to fill out that form. You should not be filling it out, but I definitely think you might want to take a look at it to make sure they have the addresses and everything in there properly. Okay, example of the 200% rule is they're going to list all the properties and they're going to put in there all the dollar amounts. Okay. So in this example, if they sold for 500,000, they've got 5 properties, it equals 995. So we're good there. They can buy whatever combination they want. The third example is the 95% rule. Well, they exceeded the 200%. Now they have to close on 992,750 of the total amount of everything they've identified. So this is where I talk about where you have to buy your entire list. Now, we're seeing some of this today where people are selling multiple replacement properties. Okay. Understand that when you're selling multiple replacement properties, the timing for the exchange is going to begin at the closing of the first property. So if you're running into a situation where you're seeing your client want to consolidate, so they want to sell, say, 3 properties, as my example shows here, and they want to purchase 1 property, the properties 2 and 3, the time frame for identifying closing is all going to start at the first property's closing. So the closer you can get all these closings together, the more comfortable you're going to feel doing this type of transaction. I've had exchanges where people were selling 4 properties in 3 different states, and you're dealing with 3 to 4 different real estate agents, 3 different states, timing of everything. And it gets very, very stressful when you're dealing with something like that. So if somebody's considering this, I think it's really important to make sure that they understand what they're about to embark on, because you have to be able to close on the 3rd property before you can close on your purchase. Okay. And you have to identify what that replacement property is going to be within the 45 days. Now, it does not mean that you have to close on the 3rd property by the 45th day. It just means that you're identifying what you're going to buy, but that 3rd property has to close before you can close on your purchase. Okay. Keep that in mind when you're looking at a multiple property exchange. Now, what's extremely common right now is somebody selling 1 property and buying multiple properties in the exchange. And they have to identify all the properties they're going to be buying, and they have to close on the last one by the 180th day. So multiple property exchanges are very, definitely on the buy side, are quite common. On the sales side, not as much, but because they're very difficult to accomplish, especially if you're doing multiple states. Okay, so let's go over certain situations that we run into from the exchange. Fix up costs before sale. This is something very, very common. People come in and go, look, I had to replace the carpet. I had to paint the property. I had to do all this. Can I recoup my money? And the answer to that is any money you take out of the exchange to reimburse yourself, you will pay tax to the amount of gain recognized. It doesn't mean that those expenditures that you'd had couldn't offset the taxable amount that you're going to be receiving back if you're trying to recoup your funds. But you have to understand that some costs are considered repairs, some costs are considered capital improvements, and they're basically dealt with very, very differently. So if there are fix-up costs that you're doing, we're getting ready to sell a property, understand that if you want that money back, you're going to be subject to tax. Okay. How that's going to look, I don't know. You're going to have to talk to the tax advisor to determine that. All right. So those are costs that are subject to tax. Now, the G6 restrictions. The G6 restrictions basically mean that as a qualified intermediary, we can only use the funds to purchase the replacement property. Now, there've been examples where somebody has trying to purchase a property in an exchange, a lender saying, well, we'll lend you the money, but you got to pay off this car loan. You can pay off the car loan when you buy the property. And the person saying, okay, well, I want to use exchange proceeds to pay off the car loan. That would be a complete violation of the G6 restrictions. And we, as a qualified intermediary, would not release the funds to pay off the car loan. Okay. That would blow could potentially blow the entire exchange. So G6 restrictions means the funds can only be used for the replacement of for the replacement property. If somebody's exchange fails, we can only release the funds once the exchange is officially over. Now, this comes up a lot in a sense of when somebody's exchange has failed, like, when can I get my money back? Well, it depends. If you've not identified any properties on day 46, you can't identify any properties. So therefore your exchange is over. We can release your funds. If you have identified properties and you're past the 45 days and you're not going to go forward with the exchange, you're not going to buy any of the properties, we can't release your funds until day 181 because you have identified properties. So again, G6 restrictions. We went over partial exchanges. They're doable. You just want to make sure that they make sense. Reverse exchanges. Getting a lot of inquiries on reverse exchanges because we're in a market right now where if you find a property, you need to lock it up because there's a lot of buyers out there. What I caution you on is when we talk about reverse exchanges is that before you tell your client they can do a reverse exchange, they really need to have a conversation with somebody like me, a qualified intermediary, to go over what a reverse exchange actually is, the costs associated with it. And then I'm going to take them through the whole process and explain that when you're doing a reverse exchange, that means you're closing on the purchase before you've closed on the sale. So the big question comes in, where did you get the money, or where are you getting the money to buy the property? If there's a lender involved, that makes the reverse exchange very, very difficult unless you're going to a hard money lender, or unless the lender involved is going to be collateralizing the loan that they're giving you with a property unrelated to what's coming into the reverse exchange. So just want to make sure that if you're dealing with the situation, that you talk to a qualified intermediary before you make any definitive statements about, oh, sure, you can do a reverse exchange. I will tell you, it's been my experience, that probably 80% of the people that would like to do reverse exchanges are not able to because of financing issues associated with it. Okay. So just keep that in mind. Now, 1031 challenges. Okay. Not planning properly. We're in a seller's market still. And somebody that is waiting to the last minute to do an exchange, you can do it. That's not a problem, setting it up. But when somebody is waiting that long to get into the exchange transaction, I have to tell you, the 45 days goes by very, very fast, especially in a high volume, high sale market what we're in right now. And I don't care what part of the country you're going by, okay? Because it's just as bad as in Florida as it is in Arcadia, okay? So a lot of buyers for properties, not a lot of inventory. So not planning properly. So in other words, not allowing enough time to go research markets that they may want to go buy in, to see what's available, to find out what they can qualify for. That's, again, financing challenges, all right? Financing's taking a while. It's taking, because inspections take a while, appraisals are taking time. So some of these issues, they all sort of kind of go hand in hand with each other, but not planning properly because the timelines on the exchanges are not going, they're not extended right now, okay? Knowing who's the tax owner and the title. again, very, very important. Sometimes people may own the property in, say, for example, their individual names. They want to go out and buy the new property in an LLC. Okay, that may be doable, depending on what the LLC is. If the LLC is disregarded, where they're still the same taxpayer that sold, that's fine. But if they're creating an LLC that's not going to be disregarded, that's going to be a whole new taxpayer, that's going to be a problem for the exchange. So you have to understand what it is you're doing. Identifying replacement property. Boy, this one, I tell you, is so difficult because so here's an example. Client doing an exchange, getting down to the 45 days, had 2 properties in contract. They wanted to buy 2 replacement properties. They wanted to identify a Delaware statutory trust as a potential backup property. In contract with both of the single family rentals, let's just say, one of the single family rentals, the appraisal didn't come in. The seller wouldn't reduce, so that deal fell through. Fortunately, the taxpayer had the DST identified and was able to use the balance of the proceeds, because they identified it properly, was able to do that to buy the other property. Identifying is so difficult. That's why it's so important to make sure that they're really planning and going ahead of what's happening in all of this, because there's so many moving parts. Financing, interest rates are fantastic, but because they are and there's so much volume, things are taking a lot longer. Okay, get these things done. So keep that in mind. And the timeline does not stop, does not stop. We sort of already went over what can be paid with exchange proceeds, but I want to highlight certain things that when you're working with clients that are doing exchanges and they're on the replacement property side, they should have reserves, okay, already away from the exchanges to pay for the appraisals that may need to be paid for, to pay for the environmental reports, to pay for the inspections, because a lot of these things you have to pay for before your sale even closes. Okay, before your sale even closes. So make sure they have reserves to deal with these issues, because if you're paying for inspections, that money's coming up front. If you're paying for points, if you're paying for locks, rate locks, that has to come out of your pocket, not out of the exchange proceeds to pay for these rate locks. So make sure that they have enough funds to deal with any expenses for inspections and such, okay? And we talked a little bit about reverse and improvement exchanges. So again, something you don't just jump at, you want to make sure that there's planning for all of that. Now, before we get to the Q&A, let's talk about what may be going forward depending on how the outcome of the presidential election comes. Okay, right now, it hasn't been decided, so we don't know who's going to be actually the president at this point. So not officially anyway. All right, so Joe Biden has his plan that he came out with several months ago. A part of his plan, and the reason I bring this up is because a part of his plan is to pay for child and elderly care, which is going to cost about $775 billion, again, according to the plan. To do that, they're looking at eliminating 1031s. All right. We as an industry, along with all the other alphabet soup, such as NAR, ADISA, you just name it, all the trade groups are out there educating, the staffers and those on the House Ways and Means Committee and the Senate Finance Committee about 1031s and how beneficial they are. I just want you to know that both parties have done this, by the way. Okay, so this is not a partisan issue I'm talking about here. Both the Republicans and the Democrats have talked about eliminating 1031s. Obama did, a part of Trump's plan, and then now it's a part of Biden's plan. So if you understand, it's not political. I heard somebody make this statement. It was perfect. It says 1031s are not a political party. Okay, so we're out there talking about this. We don't know, and again, a plan is one thing, being able to get it done is something completely different. But we're not wasting any time to educate about the benefits of 1031s. If you want to weigh in on it, there's a website there you can go into and take action and make your voice heard. But we're out there talking about that. So so just, we don't know what's going to happen going forward. We hope that it's going to continue to stay. People, I mean, because we do believe people that are elected office also do exchanges, so they benefit by this program. And next year, 2021, will be our 100-year anniversary as a 1031 company, not company, but as an industry. So we're hoping to go beyond 100 years. Anyway, so that is it. So we can now start dealing with any questions and answers. Stephanie, are you awake? Did I put you to sleep? Are you there?
Yes, I am here. I don't have
Okay.
any questions in the chat box. So if
Okay.
anyone has anything, feel free to go ahead and type that at this time.
And if anyone would like a copy of the slides, you can shoot me an email by, my email address is up there right now, dino@apiexchange.com. More than happy to send you a copy of the deck. Okay, well, it doesn't look like we have any questions. So I hope the information was helpful, and wishing you guys continued success with the rest of this crazy year and on through 2021.
Awesome. Thank you so much, Dino, for your time. We really, really appreciate it.
Oh, I do see one property. Okay.
Oh.
Sell property in foreign country and 1031 exchange in US. It's not, you cannot exchange foreign property for US property. That's prohibited. You can exchange foreign property for foreign property, obviously US for US, but they're not interchangeable. I will tell you, if somebody is exchanging foreign property, those are very difficult exchanges in the sense that you're dealing with currency issues. You're also dealing with countries that have no idea what a 1031 is. Remember, 1031s are specific to the United States, not to other countries. And so some countries, you can work through the process. I mean, we've done exchanges for people in the UK. We've done exchanges for people in different countries, France and such. But you just want to, it has to be for investment property, and it has to be with foreign for foreign again. Okay. Let's see. Here's another one. I mind elaborating on tax obligations on grantees and heirs. Okay. I take it what you mean, Aaron, is that if somebody inherits the property, if a taxpayer has been doing an exchange and all along, and when they pass away, the property goes to the heirs. Well, under current tax law, there's a step up in basis. So when the heirs inherit the property, that's going to be the new value for the heirs. So anything that's happened prior to that, any taxes that were deferred are forgiven. It's forgiven. So it's not passed on to the heirs. That's why people will use 1031s as an estate planning tool. So hopefully that's helped. But I think if you need something deeper, probably go to talk to an estate planning or a trust attorney to go over something that may be beyond what I just covered there about how the 1031s work. You know, if somebody's exchange, and then they inherit the property. Okay. So if you do inherit the property, typically there's no reason to do an exchange because there's no gain at that point. Let's see, can I send the recording or the slides? I can send the slides. I don't have control of the recording. So that would be Stephanie. So yeah, Kathy, if you want to put, if you want to email me, you can, I'll be more than happy to send you the deck. Okay. My email is, I'll type it in real quick. Okay. Okay, I don't see any more questions. All right, well, thank you everybody for participating, listening. It's been my pleasure.
Thank you so much again, Dina. We really appreciate it. And thank you to all who joined us this afternoon. And we hope you have a great rest of your week. Have a good day, everyone.